Let's get more on the Bank of Japan and what that decision could mean for the dollar and currencies. Let's bring in BK Asset Management's Kathy Lean. She's the Managing Director of FX Strategy. Kathy, great to see you again.
Great to be on.
What are you expecting, and how have traders been positioning for this in terms of their yen positions?
You know, Melissa, it's really interesting because in the run-up to the BOJ meeting, even we talked about yesterday, we have not seen a significant increase in the Japanese yen because, prior to that, a week before, 2 weeks ago, the Bank of Japan basically stayed mum on all of those reports that suggested that they were not going to change the yield curve control. But today, we've seen a rush of positions to hedge against yen strength because, we're seeing, the Nikkei report, like you mentioned earlier, about how they could potentially drop the yield curve control or allow flexibility around the 0.5% that Rebecca just mentioned. So I think, investors are not as convinced that we're going to see inaction by the BOJ. They're still trying to get a good feel about this new BOJ governor. And so I think, leading up to, we got a couple hours to the BOJ meeting, we're going to see ongoing yen strength. And I think there's a very good chance we could actually see a move by the Bank of Japan that leads to a more significant rise in the currency.
So what are the ripple effects you're going to be looking for, when we start getting headlines about the decision, I don't know, midnight or so, our time?
So what's important is that this is not an isolated issue for Japan because, you talked about this in the top of the hour, which is that it has a direct impact on the U.S. bond market. Back in December, when they last surprised with a change in yield curve control, we basically saw a global sell-off in bonds. And for the 10-year bond yield, that, coincidentally or not, marks the bottom in 10-year yields, which went from 1.35% up to 2 and now to 4. Now, of course, BOJ cannot be attributed to all of the move, but perhaps it kicked off part of it. So because the market is not completely correctly positioned for a BOJ policy tweak, if we do have a change, I think we'll see another sell-off in bonds and a rise in yields. We're seeing a little bit of that right now today. We talked about that just before. So I think you're going to see more bond yield strength and more just weakness in the prices, bond prices.
Kathy, great to get your take. Thanks so much. Kathy Lean, BK Asset Management. And spiking yields will be further weakness, I would imagine, for stocks, Tim.
For sure. And again, we're coming from one of the greatest 9-month periods of performance in U.S. stock market history. So, and yields, lower yields at one point. Look, there were a lot of people that were saying we were going to break 3% on the 10-year, and they didn't know where it was going to stop on the downside. So, if everyone's now calling for higher yields, I think there's a lot of people that have been calling for something very different. There are technical elements of what's going on here, and they also are mechanically how you value stocks. You use a discount rate, a higher discount rate, and you move up to 4%. It's very powerful in terms of what it means for equities. And again, back to Japan, one of the greatest kind of manipulators, and they talk about it. I mean, YCC equals yield curve control, and that's something. It's great for Japanese banks, by the way, though, and I think that's one of the reasons why Japanese equities will go higher.